Like everything with the IRS and the government, there's no free lunch. There's no single entity that solves all three of the pillars for which we as business owners and even social slaves must be solving: tax reduction, legacy preservation, asset protection. No trust does all of those. And if you're doing business in a trust, I hope I disabuse you of ever doing that further and immediately moving assets out if you can.
Hi, and welcome to this episode of Stacks Over Tax. My name is Sterling Grace, and with me is Mark Lewis. And today we're going to cover trusts. Man, Mark, there is so much misinformation out on social, even here on YouTube, that it really leads people so astray. And we have so many folks that show up to our door, and the information that they think they know about trust is very, very inaccurate. They think that it helps them with things it doesn't help them with. It thinks it covers them for areas it'll never cover them, and they have no idea about what's inside and how to get it back out if they need to. So if that's even applicable. So I think today we should do the soup to nuts about trusts.
Biggest thing that I want to bring to your attention before we say anything else about trusts is there was a meme that was going around. It might still be going around. And it was a golden retriever, little video. And the golden retriever was sitting in front of 3 cups on a little table. And the camera guy takes a doggy treat and puts it under one of the cups and puts it down on the cup, and then does the little shuffle thing. And the dog is looking around, trying to figure out where the treat is, and then stops, and the hands come away, and the dog literally puts the hand on the cup on the left, and the cup comes up, and it's the doggy treat. And the caption is how the IRS susses out your trust scheme. And the IRS has gotten so tired of attorneys and people and seminars and all kinds of other nonsense misusing and abusing trusts. So much so that on March 29th of 2023, they put out Revenue Resolution 2023-2. You can go look it up yourself. And that very explicitly and implicitly describes how trusts work, at least the trusts that matter the most. And those are of the irrevocable non-grantor variety. Now, we're going to talk about this. But in this explicit document, it also talks about intentionally defective grantor trusts and strips away the capital gains portion of it. So with this document, they basically have codified everything that you need to know about what you can and really cannot do with your trusts. And we're going to go over the basics of that here in the soup to nuts portion of this. But I want to mention that probably the best book that I have written, of the books that I've written, is the book on trusts, that your trust is broken. And the book's called Your Trust is Broken, and the link will be here in the description for you to purchase it on sale. It's very, very clear. It's a macrocosm of the micro that we're going to be able to talk about here. And, trusts, like Sterling, like you said, they're amazing and amazingly misused. And we need to just really dispel and disabuse everybody of the errant beliefs that we all have about trust, that somehow there's a magic bullet to be had, tax-free, a lawsuit proof, and all of these things. In some cases, that can happen. But like everything with the IRS and the government, there's no free lunch. There's no single entity that solves all three of the pillars for which we as business owners and even social slaves must be solving: tax reduction, legacy preservation, asset protection. No trust does all of those. And if you're doing business in a trust, I hope I disabuse you of ever doing that further and immediately moving assets out, if you can, into entities that are designed to do business where you get so much more value, such things as LLC, LLP, corporations, nonprofits even. So let's start at the beginning. In the United States, Sterling, how many trusts do you think we have floating around?
Well, it feels like we have a new one every week from our clients. It feels like every week somebody's got the blank, blank, blank trust and they want to know about. So I can't imagine It's got to be over 50.
Yeah, we're probably pushing 90 by now. And what makes a trust unique really isn't some crazy special wording or anything like this. It's just a little section that can go into a trust that says, this trust is now this kind of trust. And all the rules and the state regulations that allow us to be this are invoked. Okay, fine. So when we say a trust is non-grantor, that means that the grantor has massive limitations. That's the person who's putting stuff into the trust, has massive limitations on what they can and can't do, but then also get massive benefits. If we say it's spendthrift, if it's non-discretionary, if it's dynasty, if it's a retirement plan, those little riders, they create certain specificities in a trust, a certain way of maybe either granting special freedoms or creating limitations on the people that are working in the trust. But in the end, we have to know the primary purpose of what a trust does. The primary purpose of a foundation is to benefit the community. The primary purpose of a business is to make profit. The primary purpose of a trust is to hold assets in trust from some person or something over a period of time at a special trigger point that these other people or other entities get the stuff. That's what a trust is. Doesn't matter what kind of trust it is. That's what it's supposed to do. And if you have a business trust in which you're trying to make money and profit, can you do that? Yeah, of course. But there's massive rules that go along with that again, the IRS just codified for us in 2023. There's three kinds of people that are in every trust. You have the grantor. That's the person or entity that's putting the stuff into the trust. The trustee or the executor, the person who's managing the stuff in the trust. The beneficiaries, the people who are going to get the stuff. Now, of all the 50 plus, almost 90 trusts, like Sterling was talking about, like you were talking about, we have them really all columnized into two. Now, there is a land trust, but that's a whole different thing. And if you have a multi-member LLC, you're probably going to be better off than a land trust in almost every state except Florida. The rest of them are revocable, irrevocable. It's very difficult to say these and, you keep them separate because you can say, oh, a revocable trust. Oh, you mean irrevocable? So you'll hear me say revocable, irrevocable. Sounds stupid, but it keeps them straight. Revocable trusts are where the grantor puts stuff in, has max control, can also be the trustee in charge. So he can do or she can do whatever they want with the stuff. When that grantor passes, that trust becomes irrevocable and either distributes all the stuff to the beneficiaries or it's a complex trust and that other things happen. But while they're alive, it's like they own it themselves. They can do whatever they want. You can put a house that you live into it and still live in there, even though you're the grantor and the trustee. It's kind of loosey-goosey. And what the revocable trust protects you from is probate. That ugly thing that happens when you die and didn't make a good plan with your stuff. And then the state has to come in and go, we don't know what's going to happen to it. They take it all in. They do whatever they're going to do with it. They figure it out in court or whatever, take a good chunk out of it for their time, and then supposedly give it to whatever you thought. Thanks so much for joining us here on Stacks Over Tax. And if you have enjoyed being with us so far as much as we've enjoyed being with you, smash that subscribe button and make sure you hit the little bell for notifications so that every time we put out a new video or any other kind of content, you're notified and you can have the great time again with us. Thanks so much. A trust of any kind bypasses probate because now there's clear instructions, unlike a will that also has instructions, but no one swore to do anything. It's just your preference and will still go to probate. A trustee came in and said, yes, I swear under notarial jurat that I will do these things after this person passes. And now probate has to step away. It's also, by the way, how multi-member companies do the same thing. So a revocable trust primary, in fact, only real reason for existence is to protect from probate. There is zero asset protection. So, and there's zero tax benefits. Why? Because like single member LLCs, revocable trusts are just a pass-through disregarded entity. All the taxes that are coming to whatever money you're making in that revocable trust, whatever the assets are making, coming through, and the grantor must pay the tax on that. Irrevocable trusts, whole different animal. The grantor puts stuff into the trust, must walk away from the trust. Regulations as of 2023, we mentioned earlier, cannot materially participate, cannot control more than 5%, cannot get paid out of the profits of the trust, cannot move any of it offshore, cannot change the trust unless all the beneficiaries agree under notarial acknowledgement. Basically, the grantor loses all control, but gains unlimited asset protection. So in a lawsuit, well, don't you have a whole bunch of stuff in that trust? No, I don't have any control or ownership over the stuff in that trust. The power of an irrevocable trust. The trustee has unlimited power to do whatever they want, unless it's a spendthrift trust or something like this. And the beneficiaries get their stuff whenever the trust says it's supposed to get. They can't go and change the trust unless all of them agree. And under notarial acknowledgement, then the trustee must do what they say. But, when was the last time all the beneficiaries agreed on something? That really didn't happen that often. In fact, the biggest enemy of a trust is the beneficiary. So if we look at John D. Rockefeller, arguably the greatest and richest man to ever live, his maxim, own nothing, control everything. Well, how does that stack up for these trusts? Well, on the revocable side, it's own everything, control everything, which is definitely not what he's talking about. On the irrevocable side, indeed, it's own nothing, but control nothing. So JDR was not talking about trusts when he was talking about how he deployed his maxim. Not that he didn't own trusts, and not that we don't deploy trusts. But again, no single entity is the magic bullet. And for those of you who are doing business in an irrevocable trust, remember, irrevocable trusts have the second worst taxation in the code. 37% tax. That's the maximum social slave tax federally on any money you make over $15,000. Now, some of you are going to go, well, wait a minute, beneficiaries get distributions tax-free. That's true, but there's no free lunch. You can't make money in a trust tax-free and then distribute it tax-free to the beneficiaries. The trust will pay brutal tax on Form 1041, 37%. And that's just the federal side. So we got to really think about this. And for those of you who are whittling around in the 508 land, I got a 508, everything's nonprofit, I don't have to pay tax. No. If I'm at a church, admittedly a 501c3, and I'm doing a donation drive, a raffle, everybody that gives me $50 for a raffle ticket, that's a donation, that's tax-free. We all know that. Except for the winner, by the way, that's not a donation because they got value. See, that taxed the $50 for the winner, they got services. So that one's taxable. And the money you got is taxable from the winner if it's assets. But otherwise, yes, donations, just fine. But if there's a lemonade stand and they're selling lemonade, that's for profit. And the church, the 501c3, must pay tax on the lemonade. And it's the same for your 508. If you're making profit, it's always going to be taxable. There's so many regulations that say in the Internal Revenue Code, granted, in the face of commercial law, but the Internal Revenue Code that says if it's profit, it substantially changes its nature so that it must be taxed, even in a nonprofit. There's no escaping it. And for those of you who are so very dangerously trying to avoid tax or listening to the bizarre words of gurus who are saying that there's somehow the ability to avoid tax, this is not the code, and you could be in big trouble.
And I think that's one of the things that's the most terrifying about our current state of media, which is that there is so much misinformation.
Yeah.
There's hardly a client that we have that comes to us, no matter the scale and size. We have household names that doesn't have misinformation that we have to really go back and educate. And what's one of the main things, I would say that's the main thing that sets us apart from other people that do the same kind of work that we do, is that we're really committed to that Americans know the actual law and the actual code in which what they're trying to accomplish, how that's actually handled. So,
I mean, Thomas Jefferson, right? He's our guy, along with George and Ben and all them other first fathers of our country. But Thomas Jefferson said it the most succinctly. This republic We're not a democracy. We're a republic. This republic will work if, and he meant it, only if the people know the law and are well disposed to use it. Else, tyranny will reign.
Maybe he was prophetic.
Maybe he knew how the system was supposed to work.
Right.
Yeah.
So, well, as always, this has been extremely educational. I love when we do episodes that help people really think through their long-term planning, because I think folks work on life goals, but they don't necessarily work on their wealth structure and their plan for a long period of time and decades out. So, thanks so much for some great education on trust today.
Thank you. Thank you so much for joining us here on Stacks Over Tax. And if this has been valuable to you, please join us in our next video.